Hi everyone, in this video we will be doing a question debrief around the topic of rental properties. First, before we dive into the question, let's look at some key assumptions. The first key assumption that we want you to have in mind: the accelerated investment incentive is used for positive net additions. The next key assumption for these sorts of questions in our introductory tax course is the values that you are given only include buildings. These values do not and will not include the value of land. In addition, we'd like you to please remember that when you are dealing with one of these questions and providing your solution, you should be discussing and/or showing the tax consequences for subdivision B and subdivision C. So for example, ensure you indicate the capital losses are disallowed on depreciable property. And if you don't remember what I'm talking about there, we've covered that rule before. It's in ITA 39.1b, subparagraph 1. And one more thing before we dive into the questions. There are some key provisions that you've reviewed in lecture and in your readings that we want to make sure you're aware of going into this question. The first is found in Regulation 1111, and you'll recall that that regulation prohibits the capital cost allowance on rental property from creating or increasing a loss. You might find the notes to that provision to be helpful if you decide to go review it in any detail. Next is Regulation 1101 1AC. And that states that each rental property costing greater than $50,000 must be placed in a separate class. And we're going to see that each rental property costing more than $50,000 must be placed in its own separate class with nothing else in that class. We're going to see that in this question that we're about to do. There's going to be 4 rental properties. We're going to deal with all of them separately. So you've got questions, we've got answers. Let's go! You have access to this question on the Learning Hub, and I recommend that you download it and read it through thoroughly. If you are unable to access the Learning Hub for whatever reason, pause the video and read the question now. I'm just going to highlight some of the things that I think are important for you to keep in mind. And we'll start off with these numbers provided here underneath each property. So you'll see you're given each property and its information in column or format. And the first thing we are shown for each property is its class. Now, the CCA class is not the same thing as the rate. The rates are found in ITR Schedule 2, in Schedule 2 of the Income Tax Act regulations. So if you want to find the rate for Class 1 or Class 3, you'd have to go there and look it up. We're then given the cost of the building, their opening UCC balances, and then we are given the rental receipts and expenses, not including CCA for the year. So we've got our receipts and our expenses, and down here we are provided with the net rental income of each property, and this is important, it's before CCA. CCA is what you're going to be dealing with and trying to calculate in this question. Some other information is provided, and I'll just highlight what I think again is important. So item 1, the property at 26 Hart Street was acquired during 2020 for $1.18 million. And I think that's important to note that you have a net addition for that property. The 26 Hart Street property was acquired during the year. It's a new property. For item 2, there's a few things we want to bring to your attention. For example, the building at 32 Barton Boulevard was sold during 2020 for $231,000. So we're going to have a disposition for this property that's listed in the second column here. Also, we want to keep in mind the following information. It says that they had furnished this property several years ago for $28,750. The UCC for these Class 8 assets were $44.98 on January 1st. Given the condition of the furnishings, they were simply given to former tenants who agreed to take them when they moved out. That is all a long-winded way to tell you that the proceeds of disposition is 0 for these Class 8 assets. Next, we can look at item 3. It says during 2020, Ms. Busting spent $78,750 on improvements to the property at 14 Mark Avenue. While none of the changes were required, the tenant insisted on the changes before he was prepared to renew the lease. The key thing here is that these improvements will also enhance the value of this property. You are being told that to the 14 Mark Avenue property in the third column here, there are net additions in the year. And finally, item 4, you were told the building at 96 Flagler Street was sold during 2020 for $653,000. This last property in the column here, 96 Flagler Street, is going to have a disposition. In fact, the whole thing is disposed of during the year. Let's go ahead and try to answer this now. You can see that we've set up a bit of a template to help us answer the question. So for the 4 properties, the CCA and other information related to disposals would be calculated as follows. And we're going to do this in columnar format. We'll deal with 14 Mark Avenue and then 26 Hart Street. Then we'll go to 96 Flagler Street and 32 Barton Boulevard. On January 1st, 2020, we have the undepreciated capital cost. It's $703,250 for 14 Mark Avenue, and you'll recall 26 Hart Street was acquired during the year, so the opening UCC is 0. Next, we can start to deal with any adjustments or additions, and we do have additions during the year, and they would be treated under the rules that we find under the accelerated investment incentive. For 14 Mark Avenue, the additions, remember, were $78,750. For 26 Hart Street, the entire property was acquired, so that was $1,180,000. Under the accelerated investment incentive, we are to increase the CCA base by 50% of the net additions. So for 14 Mark Avenue, the net additions were $78,750, and we'll add that. For 26 Hart Street, the entire property was added during the year, so the net additions is $1,180,000. 50% of that is going to be $590,000. We now have a CCA base that we can work with. If you went to Schedule 2 to look up the different classes, you'll see that we have Class 1 and Class 3 assets. So the maximum CCA that can be taken thus far is going to be $41,069 for 14 Mark Avenue and $70,800 for 26 Hart Street. And remember, 14 Mark Avenue was the Class 3 asset and the CCA rate is 5%. 26 Hart Street, I think, was the Class 1 asset, and that'll be at 4%. Let's take a look at the other properties. 96 Flagler Street had an opening balance of $514,800. 32 Barton Boulevard had an opening balance of $266,250. These were the properties that were sold during the year. So our dispositions, remember, are the lesser of the proceeds of disposition and the original capital cost. Now, for the 96 Flagler Street, the capital cost was $570,000 and the proceeds were $653,000. The lesser of the two is $570,000. So our disposition for the sake of this property in this class will be $570,000. For 32 Barton Boulevard, we can see that for whatever reason, the proceeds of disposition are actually less than the capital cost. And because that's the case, the disposition that we'll have for Barton Boulevard will be $231,000 from its class. We see here that we've got different subtotals for each. We have a negative subtotal for Flagler Street, and we have a positive subtotal for Barton Boulevard. Now, this cannot remain this way. We cannot leave with Flagler Street having a negative balance or Barton Boulevard having a positive balance because both of these properties were the only assets in the class and they've been sold. There's no assets left in the class. So we must deal with this. We cannot leave a positive balance unattended if there's no asset attached to it. And we cannot have a negative balance in a class. First, we'll have recapture. Recapture, you'll recall, is an amount that needs to be included into income. One way you can look at this is you could say that the business has been taking too much CCA, and now it's going to be recaptured. The excess CCA that was taken over its life is recaptured and put back into income. Here we have a terminal loss equal to the same amount, 35,250. And that will be a subtraction or a deduction for the taxpayer. Now that we've done this, the recapture and terminal loss, our CCA basis will be at the appropriate amount, which should be 0 or nil. And hopefully this makes sense to you. If we only had one asset in each class and the assets are disposed of, there shouldn't be a CCA base at the end of the day. Now, before we go ahead and start to add and subtract all of this information that we've done for the different properties, we need to remember that they did have that furniture that they ended up giving away, and that was class 8, those assets. So if we were to go about handling that, okay, our opening UCC balance was $4,498. From that, we subtract our disposition. And the disposition is going to be the lesser of the proceeds of disposition and the capital cost. If we take a look at those, we'll see that the cost was $28,750, but they gave it away basically, right? It wasn't worth anything. So the proceeds of disposition are going to be nil. And if that's the case, our dispositions from the class is going to be 0. Just taking this through, the balance with no remaining assets in the class was 4,998. This means we can take a terminal loss, which is the deduction for the taxpayer of the same amount, $4,498. And again, there's no assets left in the class, so the CCA base should be left at 0 once we're done. Now we can take all of those calculations and start to put them together to figure out what our subdivision B net rental income is going to be. So our income or loss before CCA, we actually were given that information for each of the first 4 properties, correct? And here it is reproduced. This is straight from the original question. Hart Street had 5,619, Barton Boulevard was a loss of 2,738, etc., etc. Next, we should consider adding the recapture. And after recapture, we should consider the terminal loss on the class 1 asset. That was one of the buildings that was sold. And there was also a terminal loss on the furniture that was sold. Totaling all of that up, our income before capital cost allowance is $33,783. And if we go back and think of those key provisions we talked about earlier on, you'll recall that we cannot take capital cost allowance to create a net rental loss. So the most CCA that can be taken for this taxpayer is $33,783. So they cannot create a net rental loss, but they can create net rental income of 0. Now, if you're wondering which property of the remaining properties do you take this capital cost allowance from, you'd want to look at how much you can take from each property to begin with. Let's take a look at that again. And going back to the 2 remaining properties, 14 Mark Avenue and 26 Hart Street, you'll see that the maximum CCA before being restricted by net rental income is more than $33,000 for both properties. So now the question becomes, from which property should you take the deduction? In your lecture notes and in the PowerPoint slides, there's an example which illustrates that while there's no tax provision that dictates which property you take the CCA from, it's good tax planning to take it from class with the lower CCA rate. And before we wrap up, we did ask you to remember when doing questions like this to deal with subdivision B and subdivision C consequences. So let's go ahead and get at it. And while the overall net rental income is going to be nil, there would be a taxable capital gain on the disposition of the 96 Flagler Street building. Let's take a look at the calculation. It would be $41,500. Remember, the proceeds of disposition were $653,000, and we were subtracting a capital cost. The original cost of the building was $570,000. That would be your capital gain. Multiply that by a half, and you would get the taxable capital gain of $41,500. And please remember, it's important that you show the marker that you've considered everything. So there was another building that was sold, the 32 Barton Boulevard building. And remember, because it's a depreciable property, the sale cannot create a capital loss. So that capital loss, or the loss that you may have calculated when dealing with that, would be denied. That's all for this topic. We've tried to keep it at the introductory level. Until next time, thanks for watching.